How can we tell when markets are about to change direction from a sell-off to a rally, or from a rally to a sell-off? These are the turning points in the so-called market cycle. In this video, I explore ideas by the legendary investor Howard Marks to see what to look out for, how to avoid making costly mistakes, but also how to spot when the stock market is about to turn. This video is sponsored by Blinkist. These ideas are controversial because they involve what's called market timing. Now, there's a very widespread school of thought that says you should just buy equity, stocks, and hold them for as long as possible, and simply ride those ups and downs, because over the long term, equity drifts upwards. However, there have been long periods in the past, and you can see some of them beside me here for the S&P 500, the US stock market index, where markets have gone into reverse for a long period of time. So if we go back to 1950, you can see that there have been two lost decades in the US. One of them was between 1973 and 1985, when the stock market fell and it didn't recover its previous all-time high for a period of 11.9 years. Another lost decade came just after the dot-com bubble burst in 2000, so that lasted from September 2000 all the way to May 2013. So that was a 12.7-year drawdown period. Now, if you could time markets, then you could have avoided these drawdown periods by moving into safe assets when equity was about to sell off. So that's what we're going to be talking about in this video, because Howard Marks has published a book called Mastering the Market Cycle, in which he describes how he thinks we can actually detect when these crises are about to occur. But also when they do occur, he also points out that these are great buying opportunities. So assuming that we can call a market cycle, we can certainly monetize it. Now, what is a market cycle? Well, what Howard Marks points out is that over the long term, we have that upward drift in stock markets, say, and that's called a secular trend. Secular is just a fancy word which means long term. So the long-term trend is upwards, and that's denoted here by this red line. However, in any market, you'll see huge deviations above and below that line, and these tend to follow a cycle. So for example, at the beginning of this time period, you can see that the line is moving upwards towards a trend, and that would be following a crash in the market, say. That would be a recovery from an excessively depressed low. However, markets don't usually stop when they get to that secular trend line. They tend to overshoot. They swing past the midpoint towards a new high, which they then achieve at point C. Then markets would start to move downwards back towards that trend line. But again, they wouldn't stop at the trend line, they continue to swing past it. Then they reach a new low, so that's point F here. Then the cycle repeats. We get another recovery towards the trend line, we overshoot it, and we head towards a new high. So if again we look at the S&P 500, we can see that long-term trend is one that's quite clear. That's the secular long-term trend growth of the equity market. However, in the bottom panel here, I've actually shown the deviations relative to that trend. When we're above it, we see these periods in red, and when we're below it, we see these periods in blue. So it's not a very clean upwards and downwards movement as we saw in that diagram over this 120-year period, but you can see that there are these long-term deviations from that trend. So the key question is whether we can identify where we are on that trend and how to respond to that knowledge. And these cycles don't just apply to the stock market, they also apply to the economy. So we have long-term trend growth for any economy, and then we have massive deviations above it and below that trend. The same's true of corporate profits or earnings cycles. Sometimes we get massive earnings recessions, sometimes a surge in earnings, and those are overlaid against a long-term upward trend. And a big driver of the cycles and investment is attitudes towards risk. Those also tend to go through these periods of euphoria and despair. This is what Warren Buffett calls Mr. Market and his moods. The availability of credit also goes through these cyclical variations. Sometimes credit is very easy to get, sometimes it's very difficult. And one of Howard Marks' specialties is distressed debt investing, which also goes through these cycles. And if you've invested in real estate in the past, you'll know that that too goes through huge surges upwards and then periods of despair. Now, sometimes all of these cycles beside me are synchronized with one another, and that would tend to make the highs higher and the lows lower, whereas sometimes they'll operate in a kind of staggered fashion. Now, you've probably guessed, as someone who's into investing, I have to read a lot of books about investment, but I also read quite widely outside that subject. And so something like Blinkist is brilliant as a research tool for me. This is what the app looks like on your browser. You can also use it on your mobile phone or your tablet. But essentially, it picks up where I left off with my previous reading. And you can see that one of the books I've been looking at recently, of course, is Mastering the Market Cycle. So the ideas are beautifully structured in a very compact form. So there's an introduction. There are 6 so-called blinks which summarize key ideas distilled from this book by Howard Marks. Now, say for example, you're using the mobile phone app, you can actually listen to each of these topics as if it were a podcast. So if you're out and about, listening to the audio content is a great way to reinforce these ideas almost passively while you're doing something else like walking the dog. Now, as a viewer of PensionCraft, you get a special offer from Blinkist where you get 25% off the premium package for Blinkist. And what's even better is that you get to share this with someone else. Perhaps it's your partner. And that way you can both make use of your Blinkist subscription. I think it's a great way to have a relationship where you share knowledge. Maybe you could even have discussions about the topics that you're reading about. But if you are interested, you can start your 7-day free trial by clicking on the link which is in the description box beneath me. Now, we saw previously how markets tend to overshoot that trend line, both on the way up and on the way down. Why is that? Well, one of the greatest pieces of knowledge which Howard Marks says he was ever given was an explanation of how bull cycles evolve over time. And according to this piece of wisdom, it's a 3-step process. In the first stage, it's just a very few insightful investors that recognize that things are going to get better after a crisis. So, for example, in 2008, when everyone was in despair, a lot of people saw this as a good buying opportunity, such as Warren Buffett, for example. Then in the second stage, this knowledge becomes more widespread. But in the third stage, people get carried away and they think that everything's going to get better forever. So if we look at the rally in 2021, for example, we just saw growth stocks surge upwards to the moon, as many people said. And many people assumed that that trend would simply carry on. But of course, these things are self-correcting. And Howard Marks extended that idea into bear markets, where initially people see that things won't always be rosy. Then that knowledge becomes more widespread and many investors recognize that things are deteriorating. And then finally, everyone's convinced that things will only get worse. So this is the low point of the crisis when people simply don't want to invest. Now, why is it that these periods of euphoria and these periods of despair turn round and we head back to the trend? Or in other words, why do markets recover back to the mean? And according to Marx, there's a beautiful phrase he comes up with, which is that success carries the seeds of failure. So if we turn back to that growth stock rally, growth stocks were very profitable. Look at some of those mega caps like Apple and Microsoft. Now, what happens when that's the case is that lots of capital will rush into that sector. But then what happens is that the trade becomes overcrowded as everybody does the same thing, including institutional investors who have the most money. When that starts to happen, then the returns from that point onwards become much lower because people are overpaying for that asset class or that sector. And ultimately, that's what makes the returns go back to their long-term average or revert to the mean. And conversely, failure carries the seeds of success. So after one of these crash periods, what we tend to see is that you get poor performance for some period of time. And as a consequence, that asset type or sector gets cheap. And that in turn means that it's primed to outperform in future. Now, a key point is that the point we are in the cycle determines our future returns. So let's say we're at a period of absolute despair, where Mr. Market is in a terrible mood, nobody wants to buy stocks, nobody wants to give you credit, and valuations tend to be quite reasonable. Well, in this environment, it's a great time to buy. And that's because, as you can see in the bottom panel, the return distribution is shifted to the right, into positive territory. It's still possible we'll get a negative return. You can see the probability of that here on the left. But what the despair has done is to make stocks cheaper, and that shifts our prospective returns further into positive territory. Whereas if we buy at the peak euphoria phase, right here at the top of the market cycle, then what that does is shift the return distribution deeper into negative territory. It could still be positive, but the probability of a positive return is now lower. So if I switch between those two scenarios, at the bottom of the cycle and at the top of the cycle, notice what that does to our prospective returns. The time to buy is during a period of despair, and a time not to buy, or at least not to take too much risk or even to sell, is when we're at the top of the cycle. But what you must never do is to sell when you're at the bottom of the cycle if you've made losses, because then you'll miss out on the upswing. And so, armed with our knowledge of the market cycle and how to respond to it, firstly we should resist euphoria. And Marx illustrates this idea of FOMO, the fear of missing out, with this brilliant quote from Charles Kindleberger, which is that there's nothing as disturbing to one's well-being and judgment as to see a friend get rich. How many people do you know that got sucked into the crypto rally when they saw their friends making lots of money with it, only to get burnt as the market crashed? But don't feel too bad about it if that happened to you, because it even happened to someone as clever as Isaac Newton. Now, he famously got burnt in the South Sea bubble because he bought stocks in the South Sea Company. Now, initially, he did really well with his investment. During the course of 1720, the stock increased almost tenfold. Now, he actually bought quite early and then sold at a huge profit about £7,000 worth of his stock. Unfortunately, at that point, the rally continued, and he watched everybody else making lots of money. He bought again at the very top of the market, and then towards the end of 1720, the stock lost 80% of its value, and he lost £20,000. And then he famously remarked, "I can calculate the motions of the heavenly bodies, but not the madness of people." So if you do see one of these FOMO rallies, don't be drawn in when everybody else is crowding into a trade, because usually that ends badly. But our knowledge of market cycles also tells us to resist despair at the bottom of a cycle. Now, the magazine Business Week jokingly referred to a cover which it had published in 1979, 40 years ago, which was called The Death of Equities. And the story in the magazine pointed out how 7 million people had completely given up on investing in stocks. It pointed out how other investments had outperformed stocks, but also how pension funds, smart money, had turned to hard assets like gold. And that's because at the time, inflation was running rampant. And the article thought that that had sapped companies' ability to increase their profits. Now, I've marked on here in a vertical red dashed line when that Death of Equities article was published, and it came just 2 years before we got an incredible rally for the S&P 500. In fact, it was a 2-decade bull run, where on average, equity returned almost 13% per year. Because of course, the point at which markets are in complete despair, the point of capitulation, some people call it, that's the point at which valuations are really low and where prospective returns are at their very best. So what Howard Marks calls this is second order thinking, where instead of just looking at what the magazines say, you think about what that means for prospective returns. Now, all of this begs the question, how can we tell where we are in the cycle? Or as Marx puts it, how can we take the temperature of the market? Now, rather than coming up with a quantitative framework with a list of numbers, instead, Marx comes up with a qualitative checklist. So as you look at what's going on in the news, just look at each of these items and see what they tell you. So let's say, for example, that the economy is vibrant. The outlook is positive, lenders are eager, credit conditions are loose, it's easy to get a loan, capital's plentiful, rates are low, investors are optimistic, and asset prices are high. Well, as we now know, that's the kind of environment to hold onto your wallet. Don't get drawn into this euphoria. This is a better time to be cautious and selective in your investments. Whereas if your checklist shows that the economy's sluggish and everything's gone into reverse, well, of course, that's a buying opportunity. So this is the essentially contrarian philosophy that Howard Marks has come up with this market cycle concept. Now, what are the limitations of this market cycle framework? I think the primary one is that extremes are rare. When we have these peaks of euphoria or despair, that tends to happen about 10 years apart. And what are we going to do in the 10 years in between? Because most of the time, markets are kind of lukewarm. For example, right now, if we look at the US, we can see that the jobs market is red hot and the economy is in pretty good shape. But if we look at inflation, that's still red hot. So where does that put us in the cycle? What we often find is that we have these contradictory signals. It's not as clear-cut as Mark suggests at any point in time. And I think for many people, we invest steadily throughout our lifetimes because we receive a salary, we save some of it, and we can't just wait for one of these crises to occur to invest that cash. But still, I think it does provide a helpful framework when we're thinking about markets. And certainly it's good to be a historian of finance and to understand previous cycles, because ultimately that'll give us a deeper understanding of markets. So there's my take on mastering the market cycle. Now, anything by Howard Marks is good, and another of his books, which is called The Most Important Thing, is also available on Blinkist. Now, don't forget our offer from Blinkist where you get 25% off their premium subscription. You also get to share that with one other person, which is a great deal, I think. 2 memberships for the price of 1. And if you want more details about that, just click on the link in the description beneath me. And, as always, thank you for listening.